Good morning or good afternoon, as the case may be. I have it that it is the top of the hour, and so I want to thank everybody for signing on. We have people signing on as we go. My name is Steve Parrish. I'm the co-director of the New York Life Center of Retirement Income at the American College of Financial Services. I want to thank everybody for attending. The topic today is government-backed retirement income sources, and we're going to do some myth busting of common misperceptions on it. And we have two excellent guests today. One you may be familiar with for those of you that have signed on to these webinars in the past, and the other is probably new to you. Before we get going on anything else, I do want to remind you that this qualifies for both CFP and American College accreditation, but not for individual state CE. I'll explain shortly the process that we need to go through to get those CE credits. But I thought we'd first start why some people are still signing on here. I thought I'd introduce my two guests, Colin Slabach and Don Graves. Colin is our new face for the Retirement Income Center at the American College. We're glad to have him here. He's now an assistant professor of retirement and assistant director of the New York Life Center for Retirement Income. And you can read his impressive bio at the that was in the invitation materials. But what I wanted to say is he recently joined us from Texas Tech University, where he's finishing up his PhD. And by the way, I saw in last Friday's edition of Wealth Management a report that was measuring the nation's financial planning programs offered by the colleges and universities around the country. And at least no surprise to me, the #1 ranked school was Texas Tech University. So welcome, Colin.
Thanks for having me, Steve.
Yeah. My other guest is Don Graves. Don Graves, RICP, is the president and the founder of the Housing Wealth Institute and an adjunct instructor of retirement income at the American College of Financial Services. So he's very familiar to many of us. Those of you who have taken RICP training will be very familiar with his expertise in reverse mortgages. Don, welcome.
Thank you, Steve. Thank you, Colin.
Yeah. And so there's his lovely picture and a little more information about Don.
I've lost weight since then.
Yeah. Well, you know how it's supposed to be extra pounds from the picture, so don't worry about it. You're actually svelte.
Thank you, sir.
And then let me set the stage for what we're going to talk about. We advertise this session as government-backed retirement income sources, and Don and I picked this title kind of carefully, so let me tell you up front what we're getting at. If I said to you, let's have a session on reverse mortgages, I'm afraid some of you that might not be familiar with it would think, Tom Selleck or Fred Thompson and others on late night TV that are hawking a financial product. And, it's probably wedged somewhere between an ad for denture cream and a magical sleep pillow. But if instead we said, considering the challenges in assuring a secure retirement income, what government-backed retirement income sources are available for many retirees? I'm hoping you'd be interested. But you might think, well, let's see, there's Social Security, there's Medicare and Medicaid, there are veteran benefits, there's VA loans, what else? Well, key what else that we want to hit on mainly today is a government-backed program that allows homeowners to utilize the equity in their homes, or sometimes called a HECM. Now, a caution concerning the use of government-backed, we want to make this point up front. The program really does have insurance from the government that helps facilitate bank lending, but we do have to be careful about how we explain how this works to the consumer. We just read a fascinating article this morning in Advisor Perspectives, if you get that. It's by an actuary, and it's entitled Evaluating Reverse Mortgages as Investments. And the article was, by the way, pretty positive about the idea of reverse mortgages done from an actuarial standpoint, but using terms like government-backed or investments, that helps us as advisors look at these programs. But I just want to be careful to state you need to be cautious in how you use that kind of terminology when discussing this with the consumer. So enough said on that. Let me set the stage. Consider some of the myths and misconceptions that we have with some of the government-backed retirement income sources. So you got Social Security, and in the last few years, I've noticed, particularly this year, there's been a trend towards discounting Social Security's viability. I mean, is it going to be a viable source for retirement income? And obviously, a lot of this has to do with that report talking about depletion of the trust fund by 2023. People go, is it going to be around? Or I think it's been exacerbated by the talk about which CPI index is going to be used. So what are we seeing? Clients don't need the money. Even if they don't need the money, I'm running into ones taking it, electing it at 62 just to do it. You know, get it while you can. And others are eliminating it from the retirement income calculation or discounting the amount they expect to receive. So how about Medicare? That's replete with misunderstandings. People don't understand the deductibles. They don't realize they need Medigap coverage to truly have major medical coverage. They don't understand that Medicare doesn't provide long-term care except for very limited purposes. And I run into this all the time. The affluent retirees who are shocked to find they have to pay a higher premium for their Part B coverage. And then Medicaid, holy cow, that's all kinds of misunderstandings there. And I think that's largely because it's so state-based, and each state tends to vary in where they're going with it. So they don't realize where that may or may not fit into planning. But the reason I started with this is all these misunderstandings pale compared to the lack of knowledge about home equity conversion mortgages, reverse mortgages. And in a moment, I'm going to ask Don to address this. But let me start with you, Colin. It'd be interesting to hear your perspective of where prospective retirees are these days about the issue of obtaining a secure retirement income. I mean, we could argue that the proliferation of 401ks originally occurred during those heady times when consumers thought they could now invest their own employers. But it seems to me the movement away from DB plans these days is not really the consumer doing anymore. It's the employers. They don't want the responsibility or liability of a fixed income for their retirees. So Colin, do consumers really get it that they're responsible for their own investing of non-Social Security money?
That's a great question, Steve. So there's really, you have to break that into 2 points. Consumers are either choosing and they're well aware that they're going to be needing to cut their lifestyle, and they're willing and prepared to do so in retirement. And if that is the case, then consumers are making a rational decision and that they are completely aware that they're going to vastly need to be cutting their lifestyle. Now, I don't really think that's the situation, because if that were true, what individuals would be doing is they'd be still getting their employer matches, which a lot of people are not. And then what they would be doing is then later withdrawing when they have access to the money and paying the 10% penalty. But most people are not doing that. So it kind of brings you to the other piece, that consumers don't understand the importance of saving a portion of their income. And it comes back to the switching from the defined benefit to the 401ks and the 403bs. It's now on the consumer, and it has now since left the employer. And I think a lot of individuals missed that change. And so I would say it's really their life decisions on how they're going to be saving is happening in a 30-minute meeting with their human resources individual. And that's really the only financial planning for retirement that a lot of people are doing. So it's really coming down to the consumers not saving for retirement, and they're going to drastically need to be cutting their lifestyle. Kind of getting to your second question, are they interested in securing retirement income sources? I would say no. Consumers are not interested in securing retirement income sources. So there was a speech by this gentleman right here, this gentleman, sorry, his name's escaping me real quick. He, in his Nobel Prize winning speech, he basically said that consumers should be more interested in retirement income, and that prompted Robert Shiller and a couple of other individuals at Princeton to write a paper that ended up being titled The Annuitization Puzzle. And the conclusion of that paper, you want to go to the next slide real quick? the conclusion of that paper basically said the notion that consumers are simply not interested in annuities is clearly false. Social Security remains a widely popular federal program, and those workers who still have defined benefit pension plans typically choose to retain an annuity rather than switch to a lump sum. And they go on to say the tiny market of individual annuities should not be viewed as an indicator of the underlying preferences, but rather as a consequence of institutional factors about the availability and the framing of annuities. So basically what that is saying is that utility maximization theory and risk aversion suggests that people should be very interested in income floors, but they're not purchasing annuities. And the study is saying it's because they're not positioned well in the marketplace, and people are positioning them more of as a gamble. How do I outlive to make this annuity worth it? And that should not be viewed should not be how it's viewed. It should be viewed as a way of securing an income floor. Well, in the worst case of market scenario, I still have this amount of money to go off of. And I've left a link to that paper.
Yeah, that's and really you're kind of saying something that I've used a lot of these webinars is that we nowadays, because you don't have a defined benefit from your employer, it's kind of a DIY DB, do it yourself defined benefit. And I'm not going to go through these. I've done these before, but we've had sessions on annuities. And as you said, people are always ready to understand how that works and the different payout options and target date funds and bond ladders. But let's focus on a huge source of potential capital for retirees. Duh, that's their homes. So let's talk about using a release of home equity. I like that term, Don, as a source of retirement income. So Don, can you kind of give us a history of equity release products?
Sure. Can you hear me, Steve?
I can.
I got a new microphone. It's supposed to be really special. It's supposed to make me sound like a famous actor of some sort. Equity release products really started to turn the century in Europe, began making their way over to the United States around 1961. What are equity release products? What were their purpose? Well, the retirees were living longer. When Medicaid was first established, Social Security, life expectancy was early 60s, but certainly now it's way beyond that. So very wise people early in the last century began to look at what do we do because of longevity and savings rate, and where can retirees get money from? Well, the biggest asset that most retirees, and not only the United States, but in Europe and other countries had was their home. Well, how do we get money out of our home? How do we release equity out of our home? Well, you could do it, sell your home, move to an apartment or somewhere, move in with your kids. You could do it that way. You could also take out a traditional mortgage or home equity line of credit and make payments. But then the thought came, well, what if none of those, is there another option? Well, there was. What if we could have the borrower stay in their home, release the equity in the form of a type of mortgage without requiring a mandatory monthly mortgage payment until permanent departure of the home? What would that do? And that began the advent of equity release programs. In 1961 here in the United States, the first reverse mortgage was done, a private reverse mortgage. 1988, the seating of the 100th Congress signed by Ronald Reagan, the home equity conversion mortgage became part and insured and developed by the federal government with the full support and weight of Congress behind it. And then, so we've got nearly 32 years of the reverse mortgage in America as a way to help sustain retirement for longevity concerns.
I guess one of the questions then is, that's nice, but is that just a nice no for advisors, or why should advisors really care?
Sure. I think every advisor worth their salt must have a cursory knowledge of the subject matter about reverse mortgages in order to factor it, at minimum, factor it out of their client's equation. Why is that? Because baby boomers are living longer. They've not saved enough and they're carrying debt into retirement. So today's advisors are being asked to solve know more, do more, solve bigger problems, to deal with the 18 risk in retirement income in particularly. And we've got the traditional tools to work with: the client's income, their investments, their insurances, or someone said their taxable dollars, tax-free or tax-deferred dollars. Someone said their now bucket, soon bucket, or later bucket. Whatever philosophy you use, that's what you have to work with. But the question is, what happens when we add housing wealth to that? Does that give the advisor an advantage to begin developing plans and outcomes that might otherwise not be achieved? And I think the answer is absolutely. But really, Colin and Steve, for me, it boils down to the word integrity, that advisors are holding themselves out to be comprehensive, suitable, fiduciary, or at least a suitability standard or holistic. And in order to do that, you have to consider all of your clients' available assets, right? You'd have to do that, all viable treatment options. If you went to the doctor and something could be wrong with you, whether it's not as irrelevant, but if something could be, wouldn't you want your doctor to have all available treatment options on the table, whether you chose it or not? You'd want every viable way to deal with that. And so it's a matter of integrity. And advisors today, again, solving bigger problems with baby boomers, you need every available resource at your disposal to shape retirement outcomes. That's where housing wealth comes into play.
Especially when it's 68% in the example you have here. I mean, that tells you it's more than half. It's something to consider. And I tell you what, before we get into the details of how they work, Don, let me ask you, Colin, since you've been working on behavioral finance, I'm just curious how it fits into the psyche of the retiree. How would equity release programs like what Don's talking about, reverse mortgages, fit into behavioral finance aspects of retirement planning?
Well, that's a great question. So I would like to say, from a reverse mortgage standpoint, how they're positioned in the marketplace is people are not tapping the equity within their homes. They tend to be using them as a way of providing inheritance to their children, or they're using them as an emergency fund. And so really they're used as a last case scenario, but there is a lot of ways, and I'm going to go over kind of a way that you could tap a reverse mortgage, and it would allow you to access that equity in your home and would allow you to secure the financial future. We'll have that for going forward. So really, they do have an option where you can pay them out over the life of as long as you're in the home, and it does provide you with this annuity form of income. And so I decided to bring up some of the behavioral annuities in that standpoint, and that is the peace of the mind. People are stuck on this paycheck syndrome, and so you're asking people to now switch from a saving to watching a balance slowly deplete, and to be able to access this portion as a paycheck that's coming in for them. People are risk averse to losses, and then again, most people don't spend down their assets in retirement. They've either haven't saved enough or they have saved enough, but they tend to fixate on this nominal dollar amount and they don't tend to spend it down.
Yeah, that makes sense. And so that's why the annuity factor, if you will, of reverse mortgages can fit. So Don, I think reverse mortgages are pretty high on the misunderstood scale with consumers. You know, they're kind of right up there with cash value life insurance. Can you give us a quick overview of reverse mortgages, some of the concerns that people have, and how to deal with it?
Sure. To those listening, have you ever mentioned reverse mortgages at a family gathering at a barbecue? You know what happened if you did. 3 people left the table and your Aunt Janie made a shank out of a plastic knife and fork and came after you. I mean, mentioning reverse mortgages at the wrong time can be dangerous because of some of the things that we've heard and seen. Over my 20 years of working, and that's all I do is work in reverse mortgages and education, I've heard things like, Don, they're too complicated and I don't want to talk about it, too controversial. They're too expensive. One fellow said to me, Don, I don't like them because they're equity strippers. I told him I didn't go to clubs like that. What did he mean? He said, didn't leave anything for the family or the heirs. My clients have never asked, my clients will never need. Or the most common refrain was, I wouldn't tell my clients to do a reverse mortgage unless pigs flew and fat ladies sing. I'm from Kentucky, so I've seen both, but I understood that because that was a popular refrain by FINRA in their written investor alert that reverse mortgages should only be used as a last resort until that was changed. And so there's some common misconception. What is a reverse mortgage? A reverse mortgage is a federally insured loan that allows retirees age 62 years or better, only one spouse has to be age 62, the ability to convert a portion of their home's value and turn it into tax-free dollars without the responsibility of a mandatory monthly mortgage payment. You don't give up ownership or come off title of your home. That's the basics of a reverse mortgage, freeing up some of the equity in your property. The loan gets repaid when the last surviving borrower permanently departs the house, moves, or deceases, just like a regular mortgage. At that time, whatever money you owe to the lender is going to get repaid, typically from the sale of your home. Sometimes there's life insurance or other assets, but the loan gets repaid, and 100% of the remaining equity passes on to your heirs or your estate. Those are the basics of the reverse mortgage.
So let's put it to work in retirement planning, because that is obviously the focus of this webinar series. I know you have dozens of uses of HECMs in retirement planning. Can you take us through a few examples? And I know we have some slides to show how they use, but take us through a few examples.
Well, let me take you through the primary basis, the slide number 15 there. And the reverse mortgage, 32 years, is coming up in February. And one of the things that caught a lot of people by surprise, the first article in the Journal of Retirement Planning was reversing the conventional wisdom. This is back in 2012, that the reverse mortgage, there are 5 foundations. We can't cover 5, but I want to give you the main one, is that the reverse mortgage has a built-in guaranteed growth factor and something most people know as the line of credit. I call it a RELOC as opposed to a HELOC, a reverse mortgage line of credit. Some people call it a retiree's line of credit. I want you to notice one of the things that really stands out is the unused portion of your reverse mortgage benefit grows over time. So on the screen there, if there's a $200,000 home and a 65-year-old, we're looking at around $79,000. Notice what happens when we get to age 85 or 20 years later. It's grown to 224. Same with the $400,000 and $600,000 home. The growth of the line of credit became really the shot heard around the world. Folks down at Texas Tech, Harold Ivinsky, Sean Pfeiffer at the American College, Wade Pfau at MIT. I forgot the fellow's name there. He won the Nobel Prize there. Robert C. Merton. Well, and so what began to happen is the understanding that, wait a minute, a reverse mortgage has a built-in guaranteed growth factor, cannot be frozen, canceled, or reduced as long as the obligations of the loan are being maintained, which is to live in the house, maintain it, take care of your property, and pay taxes and insurance, keep it down forth. As long as that's being maintained, this has a built-in guaranteed growth factor. And so all of a sudden, research began to be done. Notably, at the American College, Dr. Wade Pfau did some research. And what came out of this slide right here was questions like, well, if this is true, what would be the best time to establish this reverse mortgage line of credit? Well, early in retirement was what the research said all over the country. If this were true, is FINRA's position to use the reverse mortgage as a last resort still suitable? FINRA themselves said no. They changed their position on the last resort position in October 2013, and they removed that language. Why? Because you have something, your clients are sitting on something that was very, very powerful. And so this reverse mortgage line of credit gives access to and really what it is, Colin and Steve and listeners, it's equity insurance. A lot of us sell all types of insurance, life insurance, long-term care insurance, car insurance. People are used to insurance, but equity insurance means I have access to the appreciating equity in my home, regardless of my income, my assets, regardless of the home's underlying value. And that was pretty spectacular. And so when we focus on this, and by the way, there are about 42 strategies for retirement income planning that are based around this reverse mortgage line of credit. And Colin, I think, is going to share just one of them. And I don't want to, I get too excited here. But Colin, sequence defense and correction, protection, and market. But let me give you one before we talk to Colin. because it catches a lot of people by surprise. I got a call from a financial advisor from a large brokerage house. He says, Don, my client's a retired CEO of a large multinational pharmaceutical company. And he says, I'm managing $5 million of his assets. And he's looking at a reverse mortgage. And I asked, why? Steve, go back one. And
Oh,
I asked,
sorry.
why is he looking at the reverse mortgage? And he says, well, he's got a $4.5 million home, and he put in an elevator, and he borrowed against the home. And he says, Don, he now has $2.1 million in debt against the home, loans, home equity loans, lines of credit. And his debt servicing on that is around $21,000 a month. And so now we've got a behavioral concern. Even though he had $5 million invested over in the brokerage house, his debt servicing is $250,000 a year. And the advisor said, is there a type of reverse mortgage that could eliminate that debt servicing, that requirement? And there's the jumbo reverse mortgage program. And the reason I love telling that story is that, one, it's not uncommon, but two, it begins to expand the understanding of some of the ways that reverse mortgages are coming and being entering into the retirement income conversation. And Colin's going to talk about kind of this next slide. But when you think about reverse mortgages as a source, think about this. I just recently spoke to the Ed Slott Elite Advisor IRA group in Texas, and I talked about this line of credit. These dollars that come out of there are non-taxable. They don't impact your provisional income. So if you're doing tax bracket management, or you're working with your client trying to get them to the power of zero type of philosophy, they may not be able to take any more dollars out of their qualified plans, or their Social Security could be taxed, or they may move to a different tax bracket. Having access to a reserve fund that allows them to pull money out without impacting their provisional income has significant opportunities and conversations built in around that. And that's what advisors are beginning to say, wow, Don, I didn't understand that. And it gets real exciting. But Colin's going to talk about an aspect about portfolio erosion, I believe.
Well, why don't we first go through those common examples you have,
Okay.
just so people can kind of see how they work, and then we will get to that. I know this is one you often use and explain how it works.
Okay. Oh, good. I'm sorry. I didn't know if Colin was doing that one or not. Well, one of the things, listen, my friends send me all type of slides, Steve, and pictures and graphs that show really frightening things that can happen in the market. And that's not my world, but it scares the wits out of me. And one of the, and this was really Texas Tech first did this, and then the Funding Longevity Task Force, which was under the American College for years. Dr. Barry Sachs says, well, let's look at a couple, twin brothers. They're both married, and they've got $500,000 in their portfolio, and they're going to draw out $27,500 first year and adjust for inflation. And the first advisor, the only difference is they have different advisors. And the first advisor had the don't use the reverse mortgage unless it's a last resort strategy. So as the market experienced some negative returns in the early years, we know that's going to set up a real sequence of return risk. So by the time this client reaches the 23rd year, hopefully they're dead, because if they're not, their advisor is going to get a phone call that says, hey Bob, we're alive and we've run out of money. And then Bob says, hey, now you can do the reverse mortgage. Now the next slide says, well, what would happen if the advisor for the second couple, same type of philosophy, but they said, listen, the year following a negative return, don't take any money out of your portfolio of securities. Don't do it. And they look real happy there. And it said, if you don't do that, not only will you not run out of money in year 23, by year 30, you'll have about $1.1 million left. And they're very happy about that. And then they ask the question, well, wait a minute, how do we eat during those years where we may need money from our portfolio of securities? Well, the common answer is, well, maybe you had a cash reserve strategy and you can eat off of that. But it really, is that the best place to have money, is in cash? Well, maybe you had permanent life insurance, whole life, that you purchased at age 45 and it's got some cash value built up. That's great. But what if you didn't buy it? What if you didn't have enough? Or what if you didn't want to use it? Is there any other type of non-correlated buffer asset, non-market correlated buffer asset that they can draw from? Next slide says absolutely. because their advisor said, if we set up the reverse mortgage on the onset of retirement, that was popularized by Dr. Wade Pfau's research. They said now that line of credit is growing for you, and therefore the years following a negative return, we're not going to convert or cannibalize asset during the dips. We're going to pull those dollars from your reverse mortgage line of credit. And here's the good news, folks, is what I said earlier, because the dollars from a reverse mortgage are tax-free dollars, it doesn't impact their provisional income at all. So they're actually drawing less. And what happens in this, and we don't show it on this slide, but we look at both couples, and the difference, the net difference between the one who did not do a reverse mortgage and the one that did was nearly $1 million more to the estate of the person who did the reverse mortgage. So the reverse mortgage wasn't an equity stripper at all. It actually preserved and protected more of the assets than the person who did not do it. And well, that's just one of the 42 strategies, but it gets us to thinking, doesn't it, Steve and Colin? It gets us to thinking, wow, having a non-market correlated buffer asset, what are some of the other things that we can do? Well, that's just that's market protection and sequence correction, or whatever I said earlier. It was fancy. Sequence defense and correction protection. And so many more of those, but I don't want to take up too much time because Colin's got some great things to say, and I want to make sure we have ample time for questions.
Yeah, and let me mention, speaking of questions, that we are getting some really, really good questions because I'm able to follow this on the panel. So I want to commit to everybody that listens, and anybody that's done this before knows we're good for it. We have your emails. We will respond to the questions because I see it's going to be way more than we can probably answer. Let me move on though, because Colin does have some thoughts on how this fits into portfolio sustainability. And I think that's an important point that we can make as we go along.
That's a great point. So what I'm going to do here is now do a portfolio sustainability around the income floor strategy. So Social Security is by far the most powerful tool in extending the income floor. It's a great deal, and this is the reason why, because in 1983, the Social Security legislation did a drastic change to Social Security. And the thing that they did is they said, Americans are living longer. We need to gradually increase the full retirement age to age 67. So that is in the process. And then one of the other things was a really, really safe assumption in 1983. And that was to assume that a 10-year Treasury note was at 2.9%. So now let's fast forward to today, 30 years later, or way more than 30 years. And longevity of older Americans has outpaced this assumption. So Social Security has priced this assumption, and they should have priced it way worse. Our full retirement age should be probably more like something around 69, 70 instead of 67. And then our current 10-year Treasury note is saying 1.6%, and it's continuing to drop. So Social Security is a phenomenal deal from an annuity standpoint. So if you just want to go to the next slide, so how do you implement a reverse mortgage into helping you delay that Social Security? Well, the first thing that you can do is you can take the lump sum of cash to fund high initial retirement expenses. So now a lot of people is focused on these distributions, and they say consistent distributions over time. But there are a lot of one-off, say, high expenses in retirement. Say you're wanting to move, purchase a new home. There are these high expenses. So you could do a lump sum of cash that would be helpful to fund those one-off expenses. A term, so you can do the reverse mortgage as a term. So you could set up equal periodic payments that subsidize what you'd be getting from Social Security from ages 62 to age 70. And then as Don has gone into detail about that line of credit, it does grow. It's phenomenal if you set it up early, because it is going to grow, and you can use it as during those bad years. You pull the money out during the bad years, and it lets your portfolio continue to grow and recover from those down years. There's a lot of research around the initial 5 to 10 years in retirement are some of the most dangerous years because of bad timing events. And if you're withdrawing from a portfolio that drops significantly in those early years, then you're at high risk of running out of money. And as Don showed in his example, there was a difference between $0 and $1 million. And then another thing is a lot of expenses is kind of a U shape in expenses in retirement. And at the start, there tends to be higher expenses, and then expenses tend to steadily decline, but then they tend to increase at this inflection point, and they do reach very high at the end of one's life. And that tends to focus primarily on medical expenses. So it is a great way to use that line of credit. Even though you set it up early, you may never use it, but you do have this nice pot of cash for the end of life expenses.
Yeah.
You can really dive this into, go ahead, Steve.
Well, I was just to say, and I think everybody listening should remember that's why we use the term government backed or government benefit, because what we're talking about here is not just taking a hypothetical 4.5% out of an equity portfolio. You know, we're starting to put some flooring strategy with the Social Security and with the HECM. So I just think that fits nicely. In fact, I guess where I would go is back to you, Don. You know, we know that a lot of retirees are active with changes and where they live at retirement. So with the time remaining, can you discuss some of the more, I'll call them financing-based uses of HECM? I mean, we've gotten at a lot of it. But what are some of the uses, some more uses you can use for HECMs in this strategy?
That's a dangerous question to ask me in 20 years in doing this. But I just want to say the American College has really been at the forefront of this conversation for a long time. And the RICP program really tackles this. I'm excited. But there are 42 strategies. The HECM replacement, and I talked about it with the retired CEO. One of the things that happens is how many of your clients are coming into retirement having a mandatory monthly loan payment, either a mortgage or home equity line of credit? Very common strategy for advisors to talk to. And let me rewind this 30 seconds. I was teaching at the Arizona Institute for the Society at one point, and a fella received an email from me that I usually send after webinars, and he said, Don, we're RIA, and we've done a lot of research. We don't think a reverse mortgage is a prudent strategy for any of our clients. And maybe that represents some on the call. And I asked the fella, and I said, well, and I asked those on the call, I said, well, listen, let me ask you 3 quick questions. What percentage of your clients who are at or near retirement do you honestly think would have a need for a reverse mortgage? And most people on the kind of CE webinar type of things would say, Don, maybe 5 or 10%. I said, great, that's very honest. Second question, what percentage of those clients are 100% certain they'll have a great retirement? Not what we feel, but what they feel. That's a small number, isn't it? Here's the third and final question. If there was a proven resource that allowed those clients to increase their cash flow, reduce their risk, preserve assets, improve liquidity, or even add new dollars back into their retirement savings. We had a little sound in the background. I said to increase their cash flow, reduce their risks, preserve assets, improve liquidity, or add new dollars back into their retirement savings. If there was a proven resource that did that, what percentage of your clients would want you to tell them about it? Well, the answer is 100%, right? 100%. And that's what the newly restructured reverse mortgage is designed to do. It went under 2013, 15, 17, and 18. It was restructured to accomplish those financial planning or retirement income planning strategies, increasing cash flow, reducing retirement risk, preserving assets. We just saw an example of that, improving liquidity. There was a slide on that, or even adding new dollars back into retirement savings in a way that's legal, ethical, moral, and compliant. And that's done through the HECM for Purchase, an all new type of reverse mortgage that allows your client to move to their next, last, and best home for about 50 to 60% down and have no monthly mortgage payment. Well, Don, what happens when my client sells a home for $400,000, moves to a $300,000 home and has $250,000 left over? I said, you've just restructured, you rehabbed their retirement income. And so there are many of those strategies. And Steve, I want to make sure we cover the questions. But if you remember, increase cash flow, reduce risks, preserve assets, improve liquidity, or even add new dollars back into retirement savings is what the newly restructured reverse mortgage is designed to do. It begins to open up a dialogue and a conversation.
And maybe this is a good point to add one of the questions that I see popping up on the screen, and I think people sometimes misunderstand. Can you address what the costs are of a mortgage, the getting the process going, if you can have a line of credit, just kind of a rough idea of what the costs are?
Sure, there's a cost with any financial tool, right? Whether you're buying life insurance or an annuity or mutual fund, there's always a cost associated with it. And so a reverse mortgage has finance closing costs like any mortgage. What goes to the lender, FHA insures most of these, so what goes to FHA, then your third party closing costs like title insurance and things of that nature. Um, to I'm going to give some resources, and then I can go into more detail. There's certainly a whole chapter in my book written on that. The chapter is called "Are Reverse Mortgages Expensive?" And so we cover that in detail. But I'll give you a few resources and a way to get a hold of those things in a moment. But that's a great question.
Okay, and just, yeah, I think people want to know that because they're concerned, gosh, is it going to cost me too much as we go along? Well, let's do this, because another thing that people are asking on the questions is where can the audience learn more about reverse mortgages, and particularly what you're doing? I mean, where can we learn more?
Sure. The internet is certainly a wonderful source. You may have a cousin who does it, and but I've got some educational resources available at Housing Wealth, www.housingwealth.net, and you can find that there. But here are four that I'm happy to send you, educational resources: 25 ways to use a reverse mortgage. We put this list together. Investment News, we work with them, and 12 smart, savvy ways to use a reverse mortgage. Forbes magazine, Neil Krishnaswamy wrote a wonderful article. Neil was one of my students, and he summarized one of the lectures, and 5 ways a reverse mortgage can help your client's retirement. And then my favorite here is Dr. Robert C. Merton, Making a Case for a Reverse Mortgage and Retirement Income Conversations, produced by the American College. That really is a fantastic resource. I'm happy to provide those to you, and I won't bother you. We'll just send them to you. And go to the next slide.
Okay.
And because here's a lot of times we're on a call like this and say, Don, is there some further training for that? Sure. I taught in the RICP course, but out of that, a lot of advisors says, Don, listen, that was great, but you know what I need to know? I need to know the 42 strategies that you talked about. I need to know how to identify clients with whom a conversation may make sense, how to introduce the subject matter in a way that fits who I am, and then how to pass the baton. So we went into the studio, we recorded a course that answered all of these questions, all the questions that you probably have, and we put it all in a 4.5-hour course. And it's really been tremendous for advisors and it comes with some continuing education credits. It's approved for CFP credits. But you can go to housingwealthcourse.com, and if you've got anything for me, just email me, askdongraves@gmail.com. But I want to provide whatever you may want to have in an educational way. We're not representing anybody, not wearing a t-shirt or a logo. We want to give education to advisors because I think it's critically important. And so you can get more information at askdongraves@gmail.com or any of the things I just shared with you. But if you want to preview the course, go ahead, and we've got a free preview and you can test drive it and see what you think. Thanks, Steve.
Good, thanks. And what have we been talking about is education, and that's the exciting thing about this. So there's been several references to my co-director, Dr. Wade Pfau, and all the work he's done. And now I'm excited to have Colin, especially since he's been doing some interesting things with behavioral finance. And unless the client's happy, no one's going to do it. So it's really helpful to have your angle from it. I mentioned this morning in Advisor Perspectives, an article by an actuary looking at it from an investment standpoint. And then, of course, we have Don, who knows so much about it from so many different perspectives. The reason we wanted to have that is because this is part of our RICP course. So if some of you are alumni and have been using it and we're reinforcing it, for some of you that haven't taken it yet, a great place to start is by going through that designation. First of all, we constantly have increasing number of enrollments and alumni for RICP. And frankly, the great news is we're also getting more credibility, if you will, among professionals as to this, because it's the one designation program that's laser focused on retirement planning. So before we go to questions, just very quickly, relative to such planning and education, and again, thanking you, gentlemen, for what you covered, but we're going to see if we have questions for you. The next session is going to be less than a month from now. I just wanted to mention it, November 5th, and it's going to be at 3 o'clock Eastern. Our guest is a financial planner and New York Times bestseller, Ellen Rogan, who some of you have heard of. And she's going to be talking about generosity, the new currency in the business of advising. And I just want to mention, because we try to do this with these webinars, she goes beyond the normal thinking about EST investing or charitable planning and really looks at generosity, focusing on that really at the planning level, at the actual practice management level. So I wanted to mention that. So with that, then let's see what questions we have, and so many of them are going to be Don-based. That if you can see them there, do you want to address some of those, or I can feed some of them to you?
Let me pull it up here, see if I can see them.
You've answered several of them, but there are some good questions.
Go ahead and feed me some while I'm going to expand this window and see.
Yeah, a good one is, how do these strategies work when the real estate market goes down as well, like when we saw with the Great Recession? How do these strategies work in that kind of a down market?
Sure. And because the particular strategy, the one we focused on, was the reverse mortgage line of credit, one of the 5 foundations. Once a line of credit is established for a reverse mortgage, that line of credit is going to grow regardless of the home's underlying value. So what that means, if your client had a $400,000 home and established a line of credit at $180,000 and it was growing, let's say at 5%, even if their home value went down, that line of credit would continue to grow, possibly even surpassing the home's value. And yes, the client would have access to that. And so down market, up market, and this really becomes equity protection in a lot of ways. If you thought you were going into a down market, it may be valuable to have that line of credit conversation to at least see how it could grow.
And being the estate planner, I like this question. What happens when the homeowner uses all of the funds and doesn't repay any of the outstanding balance? I think it's important for people to understand really what happens at death.
So the borrower had $180,000 and they went down to the casino and they spent all $180,000 in one fell swoop, or they took it out over time. What happens? Nothing happens. The 4 responsibilities are: the client must live in the property, at least one of them, husband and wife, maintain it, pay the property taxes, and keep insurance in force on the property. Those are their 4 requirements. As long as they're doing that, as most homeowners do, they simply have run out of money in their reverse mortgage line of credit, but they continue to stay in the home as usual.
Yeah, so there is a estate planning value to what you're doing. One thing we didn't talk a lot about is the age restrictions here. So I like this question. My wife is 59 and I'm 66, and we own our house jointly. I can take out a HECM for myself. How does that work with her name on the deed?
Sure. The one of the corrections in the restructuring of the reverse mortgage, if there's a husband and wife, it used to be that both had to be age 62 or better. Only one spouse has to be age 62 or better, except for the state of Texas, where you have to both be of age. And so the husband would be considered the borrower and the wife would be considered the non-borrowing spouse. So you can get a reverse mortgage. If the husband predeceased her, she could live there in the home with the reverse mortgage as long as the conditions of the loan were continuing to be met. And so you can do a reverse mortgage if you've got a younger spouse, except in Texas.
Well, everything's different in Texas. Colin, you may have a thought on this as well, but I'm getting a couple of questions dealing with this, what we can and can't say. We have one person who says our brokerage firm is requiring us not to discuss reverse mortgages with our clients. And another one had said, what do we really mean by being careful about talking about the fact that it's government backed? I'd be curious to know what both of you, how you feel about that at the consumer level.
Well, it's a Great point. I think it comes back to, it's just the cash value of life insurance. I think a lot of people in academia would agree that it is an investment and it should be looked at, looked in that way. However, you cannot say that to a consumer. And that's very important to really take that initiative. There's a lot of government initiatives to get people in homes, and they're direct government subsidies. And this is not that. There are repercussions if you don't pay the loan back. It is no longer your home when you move out. And so you want to make sure that you're positioning this as, here is not just a free way for you to have money. This is not just a government-backed thing that's like Social Security where you've paid into it, now you're getting a payout. This is actually tapping the equity within your home. And so I wouldn't say government-backed just from a regulator standpoint, and I would definitely talk with your compliance department. It's interesting that the company has taken a stand against reverse mortgages and saying you should not talk about reverse mortgages. It sounds like there may be an education opportunity there where they're worried about this thing, or they don't know enough about reverse mortgages that they're really say, okay, we're not even going to examine that as a piece of the portfolio. And it is kind of a shame that they're not taking at least an examining it, and then maybe setting up some parameters that an advisor can work within. Don, do you have any more comments on that?
I do. And the kind of broker dealer and compliance world, I got a phone call, an advisor who was managing money and also had some annuities with this client. The client came to them and said, hey, you're telling us we're spending too much to kind of sustain the lifestyle we want to have. We want to cut back, and we've got a mortgage that we're paying $1,200 a month. We've got 17 more years to do this. We read somewhere that Forbes magazine, an article by this guy that said that we could use a reverse mortgage to eliminate or replace our existing mortgage, and then we could save that $24,000 or whatever the amount was, because 14,000. Would that make a difference? And the advisor says, I can't discuss this with you. And the client said, I beg your pardon. He says, wait a minute. If we eliminate our mortgage, we're going to save $14,000 a year. That means that the draw is less on our portfolio, right? That means it's going to last longer, right? And they did some online calculating and said it's going to last another 15 years. And it says, so we can do the reverse mortgage and do that. And the advisor says, my compliance department doesn't allow me to talk to you about that. And he called me after he had just got cussed out by the clients who took their dollars and left. He said, Don, it's ridiculous. I said, it is ridiculous. I said, and something that Colin said, the compliance and broker dealers folks, they want to make sure that advisors stay, draw within the line, stay in your lane, which means you're not practicing law without a license. You're not talking about reverse mortgages, giving rates, fees, terms. They don't want you to do that. Number two, they don't want you to accept a fee or commission for that. Number three, they don't want you to take the direct proceeds of the reverse mortgage to invest in any type of annuity, any type of product. Those are the three concerns. And so what's happened is that we've done a lot of education with broker dealers to say, nope, that's not what we're talking about. So the largest independent broker dealer in the country last year, December 28th, lifted their restriction. That was LPL. That's public knowledge. Lincoln Financial lifted their restriction. Mutual of Omaha purchased a reverse mortgage company, and other broker dealers have followed suit. So it was really the groundswell came from the advisors upward, because the advisor says, I can't do my job. I can't really be holistic, comprehensive, maintain a fiduciary standard, even a suitability standard, if I ignore most of my clients' largest asset. How could I hold myself out to really be a financial advisor? And so the tide is changing. The person who asked that question. So we've got some information on that. If you certainly reach out to me, we talk a lot to broker dealers and do some things there. And so Yeah, that's their concern. And the idea about government backed it versus, and you have to be careful. I don't usually use the word government when I speak about reverse mortgages, even though it's a federally insured loan. Any changes had to be signed by the president of the United States. And but people confuse government backed or government sponsored with government benefit, and that's where we run afoul. So it's a federally insured loan is what it is. But you know what? There are three programs. There's Social Security, there's Medicare, and there's the home equity conversion mortgage that really make up a three-legged stool that can help many retirees. So if you don't have an issue with Social Security or Medicare, the home equity conversion mortgage enjoys similar, if not even stronger, protections and support.
And I suppose one of the things to conclude on that, I write for Forbes, and a couple months ago I wrote an article about misunderstood financial concepts, and that's why I wanted to have this. HECM is certainly one of them. Living trusts are misunderstood, and sometimes people are told they can't even talk about it. Life insurance use from an investment or savings standpoint, there are actually state laws against it. Some insurers don't allow producers to talk about life settlements. It is important to be aware through your broker dealer or whoever you're working with, your insurer, to know what terminology you can use. So I think it was a good discussion to have that. One other thing, because I think we have just a minute well, there was one quick question that I can answer just as a tax attorney. Someone said, how come the money coming out is tax-free? And it's simply, think of it kind of like a return of basis that you would get off of life insurance. You're getting your money, your equity, hard-worked equity back. So that's why the tax-free nature of it. But what a wonderful opportunity. One last question, Don, is kind of technical, but the term option, which is a good one to have, is it locked in similar to the referenced equal periodic payments? I'm not sure the answer to that one.
That reminds me of like 8th grade science, a periodic table of elements. So sorry, whoever asked, I had a flashback with that word. And the term payment, one of the ways you can get a reverse mortgage, lump sum over a 2-year period of time, line of credit, or monthly payments. Monthly payments can be a 10-year payment, which means for as long as you're living in the home and have the loan, kind of a life-only type of situation. Now there's a term payment, 3 years, 5 years, 7 years, 13 years. And that's all structured. So I don't know how to answer that. I'd need some specifics. Email me that. But that's where the tax bracket bumping, Social Security deferral, qualified plan deferral is all based on how we structure the term payment. I don't know. You said the equal distribution of payments, kind of the annuity and financial services world. I think it's similar, but I can't answer that specifically. Email me, and I'll certainly answer that.
Okay, I think that's a good place at which to finish it up. So let me give you, well, first of all, thank you so much, both Don and Colin. This has been very interesting. I hope people have learned from this. We had a number of people online, and I very much want to thank everybody and remind you that we have another one coming up from a very different angle on November 5th. Again, Don, thank you, and Colin, thank you, and we will get back on any questions we didn't answer already in this session. And with that, we'll conclude.